Hey everybody, this is Sean with Not Financial Advice. Welcome back to another episode. Today is Monday morning, March 11th, and today we're going to be talking about the brand new 5 stocks that I selected to bring my portfolio across the $75,000 mark. We're going to dive into it with an update on how my portfolio is going today, as well as a talk through of the investments I made and my overarching investment philosophy as it's developed over these last few years. I hope that you'll enjoy, maybe learn something. We're going to get started right after this.
You need to diversify your bonds.
The only problem you're going to have is that you didn't buy more. Because by the time you read about it in the Wall Street Journal, it's already too late.
All right, so here we are, nicely cresting at $75,500-ish dollars. So today the market is waiting for last month's inflation report, which can inform future Fed rate cuts. My portfolio is currently down 0.16%, a decline of $119. I am relatively outperforming the market, with the S&P 500 down 0.21%, with Russell 2000 small caps outperforming in a big way today, down over 0.75%. So as we often do here, we're going to take a look at my top 5 gainers and decliners in the portfolio today, and then we're going to do a fast rundown of the 5 new stocks that I purchased. Before we jump into that, I'll ask you to like the video, subscribe to the channel, and let's go. So today we also have news that Bitcoin had broken above all-time highs, trading near $71,000. I own Coinbase. I'm up something like 220% all time. That's leading the portfolio higher today, up 4.2%. You also have Paramount up 3.5%. Google is up 2.6%. It's been a little bit of a slump recently on some bad press. Seneca Foods is up 2.6, and Coors, Molson Coors, ticker symbol TAP, is up 2.25%. So the bottom 5 decliners today are going to be these companies. So we have Turning Point Brands down 2.7. You have Green Thumb Industries down 2.8. Best Buy is down 2.8 as well. Curaleaf is down 3.54, with Facebook as the bottom performing position today, down 3.71%. So I said we were going to talk about it. The 5 new stocks that I bought today, bringing the portfolio to $75,500. So here they are without any ado. We have Airbnb. So I just sort of jotted out one line, high level, which led me to invest in these stocks. As you can read here with your own eyes, this is a fast growing company. I view it as a consumer stock. I view it as a new consumer stock for the 21st century, a company that, something like 5 out of 7 of the last quarters has been profitable with actual real free cash flow. And so I like it. I like it for exposure to an opening economy. It's unclear what part of the economic cycle we're in right now, and that doesn't really influence which stocks I buy necessarily. But if we're going to have a soft landing, and we're going to get the roaring 20s that we were promised in 2019, which have been so rudely delayed to us for 4 years, I see this being a really smart technology play, and it's proof of concept about this new sharing economy that started with Uber, some 15 years ago. But I like Airbnb out of the 2. So I also have Cintas, and so this really ties into my overarching philosophy. These 5 stocks together as a unit really are going to do, I believe, what I want to do, which is outperform the market in my unique style. So Cintas is a company that sells uniforms to places like garages or restaurants, and then picks them up on a weekly basis and launders or repairs them. So they're technically an industrial stock, referred to by Josh Brown as a call option on America having an economy at any point in the future. So 2 of my friends' workplaces use Cintas, and they had never thought of it but it came up in conversation. I looked into it, and it's essentially non-cyclical for being an industrial. It's an industrial service company. Uh, what Joseph Carlson would refer to as a high quality compounder. I think it meets all of those criteria. So additionally, we have eBay. So my biggest single stock holding is Amazon. And, my overarching philosophy is, I buy both value stocks, blue chip dividend paying stocks, that have a reasonable amount of growth in front of them, or I'll buy growth stocks at a reasonable valuation based on free cash flow for the most part. So Amazon is my largest position. And what I saw here with eBay is a fully mature technology company, one of the sole survivors of the 99 dot bomb crash. And so it's a fully mature company with a really nice, something like 2.2% dividend payout, really low payout ratio. They have pretty solid free cash flow on a quarter-to-quarter basis, very low PE. They have a newer, true believer CEO, and so leadership is also something I look at in any of my companies I'm buying. But I think that they'll be a beneficiary of tailwinds moving consumer retail discretionary online, and they're also implementing AI into their technologies. So I can buy something that has AI and an earnings call for like an 8 PE. I'm gonna do that. Yeah, they're something like 3.5% of online retail, but they're just really unloved, and so that's a little bit more of a old school Buffett type play. Um, where some of these are more or less growthy. But then we have TJ Maxx. So this is where moms go to buy their kids clothes because their feet grow every 6 months and they need, I guess, new shoes, new basketball shorts, what have you. So this is a really great company. Again, it's a consumer stock, and so that's my only area of expertise is in consumerism because I'm a regular middle class American. And so, when a friend FaceTimes me over and over bragging about these steals she got for 60, 80% off, I had to look at that balance sheet. You know me, I had to look at that balance sheet and I decided I wanted to become a part owner in TJ Maxx. So they're the low cost provider of clothing with strong brand affinity, nice margins, and fairly defensive. What I'll say is this TJ Maxx, I look at it similar to AutoZone in a sort of a defensive way. And basically all that they do is they offer clothes around 60% off their competitors by buying summer clothes in winter and winter clothes in summer, buying overstock products from competitors. Just proves to be a superior business model with their bottom line margin looking really nice. And then lastly, this is definitely like a Peter Lynch type thing. Buy what you know. Hills Bank. I live in East Iowa. This is the bank that I've known since I was 4 years old. Um, it's my hometown bank. They give people cookies. They have really nice staff. It's a well-loved, reputable bank. They've got a great balance sheet with lots of agricultural farmland exposure that I don't have access to anywhere else in my portfolio per se. So I like that. And, just looking at its balance sheet, it really looks great to me. I know the banks seem to be viewed on a different level, but it's trading at a very fair 1.2 price to book ratio, which isn't overly expensive or pessimistic. And it happens to be a micro cap. And I guess the last thing I'll say about this is Buffett said, if you're not willing to hold a stock for 10 years, don't hold it for a day. And so, there's days the volume on this is so low, the stock price doesn't move because there's not enough shares bought and sold. And we're going to get into that in a second. But if I don't get the price on the stock for 10 years, I think I'm going to be very pleased with the results because I've been able to see their past performance, which isn't indicative of future results. Like the channel, subscribe to the channel. Well, showing your appreciation for this video by liking it rather. So let's do a speed run through this. Airbnb, we're going to be looking at 5-year charts. This is the all-time chart for Airbnb. And so they're in a really nice uptrend, up 78%, but pretty flat over the last 5 years. So I see a lot of momentum in here. I can see this as a coiled spring. I think it's going to be good. Over here on Qualtrum, not affiliated with Qualtrum. I'll leave a link for it in the description below. So Here's Airbnb. Forward PE of 36, 105 billion market cap, respectable free cash flow yield of 2.7%. And what we can see here is you have revenue up and to the right, you've got free cash flow up and to the right, you have more cash than debt, slightly diluting shareholders, but also with opportunities for really nice returns on capital. So that's sort of the overview of that stock. I'm about it. I bought it. I own it. So additionally, we're going to take a look at Cintas. I described that stock to you earlier. This is its chart over the last 5 years. Just majestic. Just majestic. This is one of those where you're not going to get a chance necessarily to buy in on a dip. So I just bought it, and this is this is uh, this is the this is the leader in this space. There's another company that's hated at a significantly lower valuation, which is deserved because they're not great. But this one is trading at a lofty 40 forward PE. Um, they do have a decent 1.9% free cash flow yield. So it's not technology. I don't have a problem paying up for value. And frankly, it may be on the outer band of it, but I'm seeing growth 7.4% a year over the last 10 years on average. Free cash flow is jackknifing. Earnings per share jackknifing with that reasonable 7.4% growth rate. And then they're also buying back dividends with extremely high returns on capital employed. So that's why I paid up for this guy. Watch the interview. And I also do this every time. It's called the idiot test. Watch the interview with each and every CEO. I actually won't name the company I eliminated because the CEO didn't pass my idiot test, but seems like a competent leader. I understand the business model, work uniforms, sell them, launder them, repair them. It's a racket, and they've got really nice margins as well. Let's take a look at that real fast. Margins going up and to the right. Bottom line profit margin like 15, 16%. I have high hopes for this company that I am now a partial owner in. So let's look at the 5-year chart on eBay. Decent performance over the last 5 years. This is when everything else started to go up, and this is up, 37%. Take a peek at its all time. Don't hate that. It's trying to break out. I don't hate that. So eBay, I own it. Here's how the company does. It's just right, yearly. It's just doing something around 2 billion, just something around 2 billion. They had a spinoff here, but they do around 2 billion a year in free cash flow. That's worth something to me. 2.14% dividend yield, 19% payout ratio. It's pretty low. $26 billion market cap, so a smaller large cap. Forward PE of 11. Massive free cash flow yield that no one cares about, 5.2%. Revenue is growing modestly, around maybe about 2% a year. But I feel like they have a small moat. More cash than debt. Hard to go bankrupt that way. Earnings per share is a little bit choppy, but nice quarters recently. And a drastic repurchaser of shares with decent free cash flow and dividend yield. This is a win for me, I think. Now I have TJ Maxx, as we described. Here's a 5-year chart, another one that's going to be hard to get into. Really great performance over the last 5 years. Let's look overall time. It's called a power stock. So I want in. I ran the values. I ran the numbers on it. I'm comfortable with it. Let's look at the last time there was a recession. 2007, 2008, 2009. Each year it grew in the recession. Growth rate is 6.2% year over year. $110 billion market cap, reasonable 24 forward PE, massive healthy 4% free cash flow yield, growing revenue. Free cash flow is looking very nice, growing at just under 5% a year. Dividends, they pay one around the same as the market, very sustainable payout ratio. This will be a dividend growth company. A lot of these companies have also some international exposure, which I always like to see in my companies. Earnings per share up and to the right, modest repurchaser of shares, really strong returns on capital employed in that low to mid 20 range. I love it. like the video, subscribe to the channel, and here's our last one, Hills Bank. So horrible performance over the last 5 years. But what we can see here is that they've actually, that's a pretty powerful yet subtle, tasteful looking stock chart, up nicely over all time. Returns come out to be about 8% a year over the last 5. Obviously, things have been weird. This is my regional bank. I know their comings and goings. I know the nice lady that answers the phone, which days they have oatmeal versus chocolate chip cookies. So a reversion to the mean means 8% returns a year, but they've got some catch up to do, performing very poorly over the last 5 years and down about 13% from all-time highs or recent sustained all-time highs. Tiny, tiny company. Let's look at the revenue. This is a glitch. This is up and to the right beautifully. Free cash flow, not the main metric banks are judged on. Just fantastic recovery here. Look at 2019, look at 2022. I like it. Good cash and debt position. They've been around since 1904. They're not going anywhere. Earnings per share are growing. Shares are flattish or declining. Interestingly, that's not right, I don't believe. Let's look at profit margin. Bottom line profit margin on 35%. You don't see a lot of skinny bankers. And the coup de grace, some guy named Yoder buying shares, insiders buying shares, 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 buying shares. Like the video, subscribe to the channel. Only reason insiders buy shares of their own company is because they believe the price is going to go up, and most of them paid more than I did. So that wraps up today's video. Again, this is Sean with Not Financial Advice. Leave a comment below. Let me know what you thought of these acquisitions, and I'll see you in the next one. Thanks so much. Bye now.